In The Big Short, he talks about the bonds and how the rate, Moody's and all of them, how false those rating systems were, AAA bonds and everything. And I remember every time I bought anything, they would quote me all these ratings and say, oh, this is great because it's rated AAA, and it makes me curious now.
Yes. Greg can say an article, I just have an article on that topic right there that just came out about the ratings process and why it was flawed in the case of mortgage securities. Rating agencies trail the market. They don't lead the market. And once again, I come back to the idea, should you buy AAA ratings, bonds? Should you buy AAA bonds? Yes. AA bonds? Yes. Buy all of them. You should buy everything. But I wouldn't buy it if a broker's selling it to me because I'm afraid that that sometimes some of the very honest people might unwittingly be part of a process where we're dumping assets. So I'll give you an example which I'm pretty sure is true. I lived through, and that is the 1980s, the real estate and the oil and gas limited partnerships that were being sold, not in competitive markets, but by brokers calling people on the phone. And they'd say, buy into real estate, buy into oil and gas limited partnerships. And then what these firms would do, the Merrill Lynch's and others of the world, they'd go find a famous real estate firm or a famous oil and gas developer and say, we want to set up this $150 million limited partnership. Give us some assets for that. Now, if you're a real estate fund and you really know what's going on, or you're an oil and gas person, you really know what's going on, and Merrill Lynch comes to you and says, sell us $150 million of assets, are you going to bring out your best assets, or are you going to bring out that stuff you're trying to unload? So, and general adage is that if a person with a vested interest is pushing a product in your way, don't buy it.
What do you get your lecturers like in 2 years?
What
do you get your lecturers going to be like in 2 years?
Well, actually, I've believed in this general idea for an awful long time. And I think I'll still believe in that in 2 years. But I had already asked if they would be kind enough to have me back. I would like to talk next year about alternative assets. Alternative assets being hedge funds, commodities, real estate, infrastructure, collectibles, and private equity. So that's what I'd like to talk about next year.
Well, all of what you're suggesting over here, I mean, all of what you're saying over here would suggest you should never get out of a stock.
Buy and hold.
But do you believe that? You should never get rid of a stock?
You know, you talk about the litigations that I was involved in. We'll try to wrap this up, but the litigations I was involved in, a lot of times they'll read like this. My grandfather bought these stocks, and when he went into the nursing home, the broker flipped him out of those stocks into this stuff, paid a huge tax penalty, and then put him into these tech stocks that went down. And you look at the stocks that were in the portfolio, and what were they? They were firms that had been in that portfolio for 50 years. And you show me somebody who's bought equities and has held them for 50 years, not selling them when they a few of them when they think they went up. You buy a portfolio and you hold that portfolio for 50 years, those people are successful, almost uniformly. And just last question, maybe?
Corning?
Yes.
Corning?
Yes.
Is that a good stock?
No.
Corning?
Bought and held.
If you bought and held Corning, it's 17.5 right now, I think. I would say that that has underperformed in the long run. It's underperformed in the long run.
A clarification there. When he says buy and hold is the right strategy for the long term, you mean A, create a diversified portfolio and then buy and hold that, not individual stocks for the long term.
Next question, please. Two questions in one.
The role, if any, for annuities or buying a whole life that has guaranteed interest.
Great question. I own a lot of annuities myself, and I think there's a real role for annuities. They can diversify away your life expectancy problems, that if you die in 2 years, you didn't use your money. If you live to be 110, you might run out of money. It's a great way to pool those risks. The problems with annuities is that they are full of fees and they're full of, I'm going to say it, a lot of them are full of just plain lies. And they're not regulated properly. Be very, very careful of annuities, especially indexed annuities. there's a loophole that allows them to sell annuities without a prospectus. If they offer some minimum guaranteed rate of return, they can sell it without a prospectus. I've seen the contracts. You can't even understand the things. Be very, very careful with annuities. Would I buy an annuity from a Vanguard, a zero fee, a zero load annuity from a reputable firm like Vanguard or TIA Credit? Absolutely. It can make it offers tax deferral and this insurance feature.
What about a MetLife?
I invest myself. I have a lot with MetLife. And if it's the no load part, but when a financial advisor takes the time to work with you, they deserve a reward for their work. But then you get into the problems that if the reward is in the product, that can be problematic. So what I like to do is pay a person a fee and then have them sell. I know this is very theoretical and hypothetical, but pay them for their time, but use commission no-load products. That would be my advice. And I certainly use a lot of no-load annuities in my life. And last question, please.
Am I to understand that you structure this so that it's set up according to your theory and you win if you don't ever have to sell any of it and you die?
No, you want to...
I mean, how do you sell it once you put it together without going onto my side of the room and saying, well, gold isn't doing well now, let's get rid of the gold stuff?
You don't liquidate based upon what went up and what went down. You adjust your portfolio through time for your socioeconomic situation. So you're heavily into equities, you're buying and holding, you're investing, you're buying more stocks, everything's fine. You say, you know, I want to retire in 2 years, I'm going to start making plans. You start moving out of equities into the safer assets. But you do it with proportionally to what you own. So you're not selling off this one because it went up and keeping this one because it went down. You're moving everything up and down
On a percentage.
based upon your socioeconomic circumstances. No effort to time the market.
So consistently rebalancing on an annual basis?
Yes, you need to rebalance. It's not a set. When I said buy and hold, that was the selection of what's in your risky portfolio. The allocation between the risky portfolio and the risk-free rate should be an ongoing revisited decision, not based upon emotion, but based on your socioeconomic circumstances. Thank you very much.
Okay.